All right, guys. Happy to get started now. I think that most people have now filtered in, and if they're not here, then too bad. You're too late. All right, I'm here to talk to you today about investing in real estate and how it can net you 20% plus returns. So I do want to talk about investing in real estate and primarily the how and why to invest in real estate. I'm going to have a number of webinars coming up in the next few months here that talk a little bit more about some of the particulars and specifics that I'll be talking about today. So I'm going to go a little bit more high level today, and we'll be able to dial into some more specifics on upcoming webinars. Just a note as well, I'll be leaving any questions to the very end, and so please use the chat, use the Q&A, put in your questions. I'll be happy to answer them at the very end. So welcome to the presentation. I'll be talking about why you should be investing in real estate. Table of contents, we'll be talking about why invest in real estate, the power of leverage, the returns investing in real estate, and then I've got it broken down into 5 steps. So getting a home equity line of credit, creating a game plan, doing the analysis, jumping into community and learning, and then taking action. And I'll wrap it up by giving everybody some quick tips on how to invest in real estate. So first of all, why invest in real estate? This is an interesting stat that 90% of all millionaires became so through owning real estate. Not to say that that's the only spot that they made money, but the 90% of millionaires made their first million using real estate, which is quite incredible. And I think that's an interesting stat. And one of the most important things about investing in real estate is the power of leverage. And so leverage is one of the most important aspects of investing in real estate. It's interesting because if you're buying your own residence, you can put as little as 5% down, and for second homes, and for a rental property, it's 20% down. Now, one of the important keys here is if you compare real estate to other investment asset classes, getting 90% leverage or 95% leverage by investing in stocks is just not going to happen. And yes, for those of you that have really large real estate or stock portfolios, yes, you can get up to maybe 50 to even 70% leverage, but getting the kind of leverage that you can get in real estate is very, very, very difficult, and that's probably the biggest allure to investing in real estate. I do want to go into a little bit about how the leverage works for those of you that don't really understand exactly how the power of leverage works here. So let's talk about a rental purchase with 20% down. So let's say that you're buying something for $500,000 and you're putting 20% down. You're putting $100,000 down on this property. If we assume that the real estate values appreciate by about 3%, that means that you've made $15,000, because if the home value goes up from $500,000 to $515,000, it's gone up 3%, you've made $15,000 on your investment. Now, keep in mind, you didn't make $15,000 on $500,000, which is the asset value. You made $15,000 on the amount that you put into the deal. So if you put 20% down, you've put 100 grand down into the deal, you've made 15% on your money. So the very cool thing is that if you're putting 20% down, what this means is that you've leveraged 5 times your money, which means that every 1% of real estate appreciation means a 5% return on your money. So typically when I run models and I look at a forward thinking situation here where I look at, what is the expected real estate appreciation, I usually use about 3% annual appreciation. And that means that on average, you would expect about a 15% annual return. Now, keep in mind, real estate doesn't seem to go in a straight line. It typically is quite jagged. So you might be owning real estate for 2, 5, 10 years before you see that appreciation. And the reality, though, is that usually when real estate starts to go up, it doesn't always go up at a nice slow pace. If you look at many different pockets of time, real estate markets can be relatively flat and all of a sudden spike. And those spikes sometimes can be a 10% or 20% annual increase in real estate values, which is absolutely insane, especially when you look at the fact that because you've leveraged yourself, you're actually getting 5 times that return. So it's not that uncommon for people to buy a piece of real estate at the right time. And if the real estate market goes up by 20%, but you put 20% down, your return on investment is actually 100%, which is kind of crazy. Now, this is where it gets even more interesting for those of you that don't already own your own home. Let's say that you're purchasing a residence with 5% down. So it's still a $500,000 purchase, but now you've put $25,000 down and the home value goes up by 3%. You've made 15 grand on $25,000. So your return on investment is actually 60%. And then to make this even crazier, what if the values didn't go up by just 3%? Let's say that they went up 30%, which we're starting to look at that in certain markets. If that happened, then you're making 600% return on your money in 1 year. And again, you would never expect that to continue, but there are certain pockets where you can see insane real estate appreciation, and that means your return on investment is even higher than that, primarily because of the leverage aspect. So leverage is one of the most important reasons to be looking at investing in real estate. So what are the returns and how do you make money in real estate? It's generally 3 different ways. So first of all, you have cash flow. And this is the one that a lot of people focus on, and it is one of the most important. In general, and it depends on where you're buying, anywhere in, different parts of Canada are going to have, positive, neutral, or negative cash flow depending on where you're buying. And cash flow in general, if you're buying a cash flow property, it's usually about a 1 to 4% return on your investment from cash on a per annum basis. So in general, a lot of properties in Canada are not going to put a lot of money in your jeans with 20% down payment because you're getting that leverage. Now, the appreciation aspect, however, we talked about that. And if we assume that it's about a 3% annual appreciation per year, then your expected return on investment from appreciation would be 15% per year. How about the mortgage paydown? And this one's really affected by where the mortgage rates are. So with mortgage paydown, you can expect to be in general 7.5% to 9%, but we've actually seen that in certain cases, especially with interest rates being extremely low and being as low as 1.5%, you can see this number even go exceed 10%. So this mortgage paydown aspect is the key, and this is one of the most important things that people do not think about. And one of the things I often will do when I speak to an audience of people, especially people that are not in real estate investors, often say, look, let's set aside the cash flow for a second. Let's just say that you find a property that just has your tenant covering your mortgage for you. And let's also assume that you have no appreciation on the property value at all either. So let's just assume that you literally have no cash flow and no appreciation. You're just buying a property where the tenant is paying down your mortgage for you. In those situations, you're getting a 7.5% to 9% per year return just having your tenant pay down your mortgage for you. Now, that's usually where I ask the audience, how many of you are getting 7.5% to 9% consistently in your stock portfolio, like every single year, like clockwork? And there's always about 1 in 50 people put up their hand. Those smart Alex who make a lot of money in real estate, or they bought Bitcoin a couple of years ago at the right time, et cetera. But the reality is not a lot of people are consistently making 7.5% to 9% return on their money. Now, the crazy thing is, and this is, if I jumped to this conclusion and I said, buy your real estate and you're going to make 24 to 27% return, a lot of people say, whoa, that's a little bit crazy. But when you break it down into 1 to 4% from cash flow, 7.5% to 9% from mortgage paydown, and then on average, about a 15% return on your money from the appreciation factor, you're making 24 to 27% annual return by buying real estate, which is a really, really cool thing to look at. Now, one thing I like to look at is how the return on investment is broken down. So you can see here that out of those returns, not a lot of it is from the cash flow, because the tenants aren't really putting a lot of extra money in your jeans. They're putting most of the cash going towards paying down your mortgage for you. And that's where about a third, about 33% of your overall return is from the mortgage pay down. But look at this pie here, 58% is from the appreciation. Now, one piece of advice I tell my investor clients is you got to keep in mind the cash flow is still very, very important. If you buy properties that are taking money out of your pocket every month, then you may not be able to hold it long enough to realize and recognize that appreciation. So it's very important that you still are buying properties that cash flow positive, because it's easier to get financing, which we'll talk about in a little bit. And on top of that too, you have to be able to hold the property for a long enough period of time to see and realize that appreciation, because appreciation isn't very consistent. It's not like the cash flow and the mortgage pay down where you can kind of bank on it. It's something that happens in spikes. But if you're forced to sell the property at an inopportune time, then you may not be able to hold it long enough to see that appreciation. So although the returns are heavily skewed towards the appreciation, it doesn't mean that you shouldn't still be buying for cash flow. So now that we've seen the returns in investing in real estate, who's in? Who wants to invest in real estate? A lot of people, right? Especially you guys. Of course, you've signed up for the webinar. You guys are interested in learning more about investing in real estate and why you guys should be investing in real estate. So you guys want to make some money or what? Here's the thing. Why are more people not investing in real estate? There's got to be a catch, right? You know, it's if the returns in investing in real estate are this good, then why aren't more people doing it is the real question. And the answer is, well, it's complicated. It's different. It's not as easy as investing in other asset classes. You know, nowadays with Robinhood on your phone, you can invest in stocks very, very simply, very easily from your couch. You know, you push a couple buttons and you've invested in stocks. On top of that, you don't need to get a mortgage. You know, anybody who has obtained a mortgage in the last little while knows how much paperwork is necessary to get a mortgage. You know, this slide is an interesting one, but it's interesting being a mortgage broker since 2006 and seeing how the business has evolved and changed over the last 15 years. The amount of paperwork necessary to get a mortgage has increased almost every single year in that 15 years, and it just continues to get harder and harder and harder to get qualified for mortgages. But it doesn't mean that it's hard, okay? And the reality is, if it wasn't hard, then everybody would be doing it, and the returns would probably not be as good, right? So the ultimate goal here is to try to make your real estate investing easy, and that's where we can come in and help out with structuring things and following a bit of a procedure or a plan here. And so breaking it down into step-by-step, bite-sized chunks to make it a little bit simpler for you to start your investing career and start making some money on your money. And also on top of that, perhaps not even making money on money, but making money on equity. And so that brings me to my first point here, which is step number one, accessing capital. And you don't have to just use cash. In fact, it's often recommended that you are not using your liquid savings to invest in real estate. Now, again, this is very case by case, but one of the most important things when accessing capital is getting a home equity line of credit. So what you often want to do is you want to get a readvanceable mortgage. And this is for a number of reasons, because it allows you to minimize the amount of tax that you pay, and it also allows you to invest at the same time. So what ends up happening over time with your readvanceable mortgage is you have a mortgage, which is the left-hand side here, your non-tax deductible mortgage, which is the amount of money that you borrowed to purchase your own home. And then you have your line of credit, which you're borrowing money out to invest in. And the idea here, and the core concept behind this, is that whenever you borrow money to invest, the interest portion of the payments is tax deductible. So when you buy a property, the mortgage interest on that mortgage is tax deductible. Also, if you borrow your down payment for that rental property against your home, then that money is also tax deductible. Now, I always will preface this by saying, I'm not an accountant. Make sure you talk to an accountant. But this is how it works. If you have a home equity line of credit, what you do is you work on paying down your non-tax deductible mortgage and reducing that. And what ends up happening is that money then moves over to the line of credit, and your line of credit limit will slowly increase, giving you access to more capital to invest. So in this case, what I'm showing here is that if you had a $500,000 property and you owed $225,000 in your mortgage, you could get a line of credit for $175,000. You would have a global limit of the combined amounts here, so $400,000. And as you pay down your mortgage, your line of credit limit will automatically increase. And so if you pay down your mortgage down from 225 down to 200, your line of credit limit would go up from 175 up to 200. So over time, you'll always be able to borrow $400,000. And the cool thing is you then use this line of credit and you borrow against it to invest. Now, I did a presentation, a webinar a couple of months ago that talked all about this. For anybody who wants to learn more about this, you can check out the webinar by going to our website. Also, I have a few extra copies of this book sitting around at my office as well. I've known Robinson Smith for a number of years, and he did a version 2.0 of the original book called The Smith Maneuver, and went into a lot of the complex strategies here. And again, it's an entire presentation all on its own to talk about the Smith Maneuver and maximizing this and setting up a home equity line of credit to invest. So all I want to say right now in this presentation is this is step number one, and that's usually where most people are accessing their cash and their capital to invest in real estate. So step number 2, create a plan. I cannot stress how important this is to create a plan for yourself. Now, everybody's situation is going to be different. So creating a game plan for somebody that wants to buy one property, for instance, is a very different game plan than somebody who wants to buy 10 or 20 rental properties. It's very important that we look at where you're at now that we know how much capital we can access for you, and where you want to be in the next 5 or 10 years. And those are two very important keys. And that's why we almost always start number 1 with where is your capital going to come from? Because if you can't access capital from your residence, then that's a very different game plan. Maybe you need to start doing joint ventures with other people, or you need to start doing flips or something else to generate cash for yourself. But everybody's going to have a very different game plan depending on where you're at now and what your current financial situation looks like and where you want to take it. So one of the things that we look at here is buying your own residence is one piece of the pie, right? And that's a very simple transaction in general. And that's usually the first step. The second step is usually your first rental property, and your needs change a little bit when you look at your first rental. However, when you start getting up to 5 rental properties, now the plan really starts to change. And for many banks, 5 properties is the hard cutoff. You cannot get more financing from that bank if you have more than 5 properties. So a lot of lenders start to cut you off, and it doesn't mean that you have 0 options. We finance clients that have 15 plus rental properties in their name. So it's not impossible, but it gets a lot harder, and your game plan needs to be really, really specific in order to grow past that stage. And on top of that, then you have clients that are looking at 5 plus and getting into commercial. And again, I've done webinars, and I have some upcoming later this year. We'll be talking about what commercial lending is and the differences between commercial lending and residential lending, because they are very different. But a lot of clients, as they grow their real estate portfolio, eventually get into what we call commercial. Just so that commercial is generally classified as anything that is 4 plus residential units or commercial. So if it's 4 or less residential units, then that's residential real estate and residential financing. Anything that's more than that, or is a commercial strip mall, industrial, anything like that, that will be classified as commercial. So how do you qualify? This is an important feature too, to understand and understand why it's harder to grow a real estate portfolio. So I'm going to show you the 3 different ways that lenders qualify you to purchase rental properties. This is the first and the most common way that lenders look at it. And so the first thing we often do is look at how much can you qualify for if we use this method. And it's called the 50% add to income. So I'm going to use an example here of $1,000 a month in rent, and I'm going to show you how the math works, because I love math. So if we took $1,000, the lenders would use 50% of it. So they'd add 50% to your income. In general, the lenders use about 40% of your income towards debt servicing, which means that they're only using $200, because they take 50% and then they take 40% of the 50%. So they're really watering it down. To put it in perspective, $200 of income is probably going to service about $40,000 in a mortgage. It's not a whole lot. And so if you have a basement suite in your house, and most banks, for instance, only use 50% add to income on basement suite rental income, if you're looking at your house, many lenders will use a slightly different method when they're calculating the rental property on a potential rental property acquisition. But this is the most difficult way of building a portfolio, because almost every single property you add to your portfolio will be a net negative, not a net positive in your application. Now, there's also something called an offset, and different lenders use a different offset, the lenders that do use it. Some are only 50% offset, some are up to an 80% offset. But the way it works is that the lenders will use 80% of the income, so $800 in this case, and then they're going to offset all of the expenses. So in theory, if your expenses, according to the lender, of course, are only $800 a month, and you're getting $1,000 a month in rent, then 80% of the income is actually covering off all the expenses, and there would be no net impact on your application of having that rental property in your portfolio. Now, in general, it's very difficult to do that, because keep in mind, most properties are not covering themselves with just 80% of the rent, number one. And number two, the lenders are using their own calculations for this, including the stress test. The lenders are using a rate of whatever the current, what they call the mortgage qualifying rate, or the rate plus 2% is. And so they're using a much higher interest rate to calculate your mortgage payments for you on the property that they're financing, which means it's very difficult to have only 80% of the rental income cover off all of the expenses that the lender is factoring in on the property. So in general, again, with this method, unless you're buying strong cash flow properties, in general, every property you add to your portfolio is still a net negative. Then there's something called the DCR. It stands for debt coverage ratio. And this means that they're looking at your entire real estate portfolio and the property that they're financing, and they want the income to be 1.1 to 1.2 times the expenses. Now, in general, they're using all of the income, but there must be a surplus. So in this case, if the expenses were $1,000 a month, then they would want to see at least $1,100 to $1,200 per month in income in order to offset it. So DCR is actually what's commonly used on the commercial side of things. And so many residential lenders, when you have a portfolio that is of 2 or 3 rental properties or more, many lenders start to use this debt coverage ratio to determine how much funding you can get. And so you'll find that over time, it becomes more difficult for you to use or to qualify just based off of your income alone. Many times the lenders start to look at, well, how much rental property is your portfolio getting as well, not just looking at your personal income. So there are pros and cons to all of these methods. I would say 50% add to income is definitely the weakest here. But sometimes you'll find that a debt coverage ratio is good for clients that have a strong portfolio with good income, but they have a low personal income. Whereas an 80% offset is often good for getting more leverage on each property if you have a very high personal income. So you can leverage your high income to allow you to qualify for more mortgages over time. But overall, it is not easy. And in general, every rental property you add to your portfolio is a net negative. And so you have to keep that in mind, that you have to be very well positioned to continue to add properties to the portfolio to keep growing. So step 3. Let's analyze some deals. It's now you've got a good framework of, you know where you're at now, you know how much capital you have available, and now you've created a game plan. And by the way, the game plan is something that our team helps all of our clients with, is looking at where you're at and where you want to be in the next 5 or 10 years and figure out that bridge. Now the key is to figure out how to analyze deals. And so I wanted to put together a slide to give people here a quick idea of how to do a deal analysis, because I find that this is something that is lacking. And in many cases, it's something that holds people back from taking that first step to start getting out there and start running offers on properties. So here's the first thing. I use shortcuts. The first thing that I always do, if I'm looking at a property very quickly, I use a shortcut. And I usually look at a very quick rent to price ratio. What this means is that I take the monthly rental income and I divide it by the purchase price, and I look at what that ratio is. So for me, a rent to price ratio that I'm targeting is usually about 0.4%. So if you're looking at, the math is really easy on $1 million property. If it's $1 million home, then I'm looking at least $4,000 a month in rent in order for that property to be about cash flow neutral or slightly positive with 20% down. You can use this math on any property value. You can use it at $500,000, for instance, where you'd want at least $2,000 a month on the property, on the income of the property. So that's a very, very quick way of looking at it to see if I'm in the ballpark. Of course, if you look at major urban centers, in general, this rent to price ratio is lower. It is more difficult to get properties to produce that much cash flow in Vancouver and Toronto. Whereas if you look at smaller towns, then in many cases, these ratios and percentages are actually much higher. So the rent to price ratio is just a very quick metric. And when you understand the market, you'll find, oh, wow, I'm noticing that this particular type of asset seems to have a better rent to price ratio. A very quick tip on this is that in general, properties with more units in it will generate a higher rent to price ratio. So if you buy a house versus a house with a basement suite, the house with a basement suite would generally offer you more rental income in total than the house without the basement suite. Same for a 3-plex or a 4-plex. In general, the more units you jam into the same amount of space, the higher the income that you're producing. The other quick shortcut that I look at is $100,000 equals $400 a month. And what I mean by that is that if you're setting up a mortgage, if you're borrowing $100,000, your payments are about $400 a month. So sometimes if I'm comparing 2 properties side by side and one's $50,000 more, then I'll do the quick math and I'll figure out, well, if I borrow that $50,000, my payments on my mortgage would be about $200 more per month. can I get more, or at least $50 more per month in rent on the property that's 50 grand more? So that's a really quick shortcut again to use when you're doing an analysis on something, and just look at, well, does it make sense? And especially when you're comparing, A to B. Now, tools. I love using tools. In fact, I created a cash flow analysis spreadsheet years and years ago, and I actually originally designed it for myself. So back in, when was it now? Back in 2009 and 2010, that's when I started looking for my very first property, back when I was about 20 or 21 years old. And I noticed that a lot of our clients were not actually using a calculator or spreadsheet of any sort to do this analysis. And so I found it odd that they weren't using some kind of third-party tool to help compare a property A to property B, and use some kind of tool to just break it down and understand, which property is better here. This property is more expensive but generates more rent. This property is cheaper but generates less rent. How do I compare these two properties together? It's important to use some kind of tool. There's a lot of tools out there. You don't want to look at just factoring in and calculating, just using our spreadsheet. There's, of course, many other tools out there. And so once you've shortcutted it to figure out, is it in the range that I'm looking for, then you use a more in-depth tool like this that factors in more of the income and more of the expenses. And so this is where you start putting in things like the vacancy rate and the property taxes and the strata fees and the maintenance on the property and all of these other factors that are very important to determine what the actual cash flow on the property will be. So my first step, and you have to understand, it's always a funnel. So you're looking at shortcuts first to figure out if it's even in the range. Then the next step, you start to look at, okay, now that I've funneled it down a little bit, now I want to start to dive into it a bit deeper and run the actual numbers on this property and see if it's going to click or it's going to work. Now, in order to really quickly look at the rents, and I get this question asked a lot, for me, I must say that doing this for 15 years, I have a pretty good idea of what rents are across the country, because a lot of our clients are buying rental properties, and that's been my niche for years. But for you getting started and starting to look at properties, a couple good places to go: rentometer.com. I love it. I use it all the time. I have the premium version, in fact, because it gives you really cool data. If you really wanted to dive into it, you can get really good data using that. But Rentometer is a really good spot to just type in the address of the property and type in how many bedrooms it is, and it'll actually tell you what the market comparable rental income out there is in the market. So if I'm buying a brand new place, then I'll probably use the rental income that's on the high end of the range that Rentometer gives me. If it's an older property and that's smaller, then I use a lower end of the range, but it gives me an idea and a very quick hit. To dive deeper into it, especially if you have more unique property, then Craigslist, of course, is helpful. But I do find, from an efficiency perspective, Craigslist is not extremely effective, because I could sit there and go into listing after listing after listing to understand whether it's in there or not. And I just find that it's not nearly as efficient as something like rentometer.com. So that's usually my first instinct, is just to go to rentometer.com and understand, am I in the market or not? Next step, I'm quickly filtering it through, and I'm looking at specific metrics to compare the return on investment. And so ideally, everything that you're looking at here should drill down to one key metric, and that's return on investment. So remember, we're making money in three ways: cash flow, mortgage paydown, and appreciation. What I want to do is I want to drill it down to one key fundamental metric, and then be able to compare that versus other deals. So a couple of things that I try to filter here is understanding a market. And sometimes I'm going to compare one market versus another. And sometimes a market, maybe a smaller town, might have more cash flow, but I would also say maybe they'll have a lower annual appreciation. And so what I'll do is I'll put in a lower annual appreciation to my spreadsheet and use that to offset the higher income that I would expect. And then I look at and kind of step back and figure out, okay, what is the return on investment now on a smaller town but better cash flow deal with lower appreciation and higher cash flow versus a major urban center deal like a Vancouver deal with a lower income but a higher expected appreciation? And how does that affect my return on investment? And sometimes you'd be surprised, even just 1% less appreciation per year is 5% return on your money if you're putting 20% down, right? Another thing that sometimes you'll find is that And I was doing this very recently. I was looking at a property where it was a bit unique, and the expectation would be that I'd have to put a larger down payment down on the deal. So then I ran the numbers and said, well, if I have to put more down payment on this deal, how does that affect my return on investment? And if you double your down payment, well, you're going to be reducing your return on investment quite significantly, because you can only buy one of those properties, where maybe another property where you can do half the down payment, you could buy two different properties and a higher total asset value. So this is just a quick snapshot of things that this spreadsheet that I designed and created help. And by the way, this is available on our website. You can download this at any time. But you punch in things like the purchase price, the down payment percentage, rent, vacancy. It'll calculate the mortgage payment for you, of course. Property taxes, condos, insurance. You factor in all of your expenses, and it'll factor in and tell you what your cash flow is, your cash on cash return, your future value of the property, your future mortgage balance in the future, your return on investment in total, return on investment annually, things like that. So as you can tell, I'm a very analytical person, and that's how I like to invest in real estate. I feel myself that the numbers don't lie. And of course, there is still a very significant touch and feel aspect to investing in real estate, and everybody's gonna have their different feeling. But I do find that that running the numbers is the first thing that I always look at. And from a again, filter system, if I run the numbers and I like it, then I will write an offer on the deal, and then I will go view it. And a lot of people actually do it in the opposite way, where they go out and they view a property first and then write an offer, and then they do the numbers on it. I like to reverse it, primarily because I'm a numbers person, but also it takes me, once I've been doing this for, once you've been flying through, it takes you maybe a minute or two to do the spreadsheet. How long is it going to take for you to get in the car, organize a viewing with a realtor, and go out and see a property, and drive out there, go view it, and check it out, and drive back home? You're talking about 1-2 hours out of your day to do that, instead of 1 or 2 minutes out of your day to do the analysis. So I always start here first. If I like it, then I'll proceed, write an offer on a price that I like it at, and if I get it accepted, then I go view it. Step 4. Get connected. So one of the things that's very interested in investing in real estate is that as your portfolio starts to grow, getting connected and starting to connect yourself with people that are in the industry that know their stuff. And I have to say that there's a lot of people in investing in real estate that lawyers, accountants, realtors, et cetera, people that have worked with a lot of clients that have been investing in real estate, that can really help you out and save your bacon in a lot of situations. But also, it's nice to be learning from other people without having to pay for these mistakes yourself. I always say it's a lot cheaper to learn from other people's mistakes than it is to learn from your own. So get connected. There are a lot of different investment groups across Canada, and there's a lot of different ways that you can get connected with these groups. If you're interested in learning more about these groups, feel free to email us, and I'm happy to do an introduction with whatever groups might be in your area or your market. Some of these groups occasionally have deals that they'll send over to me, because I may be speaking for their groups, or have some kind of affiliation. So sometimes I do get new attendees discounts, or sometimes can get people in for free to check it out. So if that's something that you're interested in, just reach out and let us know. But getting connected and learning, and that's really the first part of it, is just getting connected and learning about investing in real estate and talking to other people that are doing it is great. But what you also find is that as your situation evolves, you're going to notice that you might be starting to lean more on joint venture partners. You need to find other people that will do deals with you. Maybe you need a cash partner, or maybe you have a construction deal, and you met somebody at one of these events where they do construction and they're looking to do deals, and you have a perfect deal where you just need somebody that can actually handle that. A great example is that for instance, I'm great with the calculator and terrible with the hammer, right? So if I find a really cool deal, I'm great at doing the analysis and breaking it down and bringing in partners. But when it comes to actually swinging the hammer and building something out, that's much more difficult. So that's something that I like to bring in other people to do. Now, step number 5, this is the most important one. Take action. Don't just sit around, stare at your tail, watch it wag back and forth. Taking action is the most important thing out of all of this. Analysis paralysis is a thing. It is definitely a thing. The number of people that I see, diving into the particulars and thinking, is this deal better than that deal? A year goes by, 2 years goes by, and next thing you know, they haven't done a thing, and the real estate market has appreciated 10 or 20%, and they could have just bought anything and could have made money. So ultimately, at the end of the day, all of this knowledge is great, but if you don't take that information and effectively turn that knowledge into action, then all of this is a waste of your time. Let's be frank here. So it's really important that you start to take this knowledge, start to get more comfortable, and then start to dig in and start looking at places, doing the analysis, writing offers, and actually taking some action. So that's really the fifth step and probably the most important step is starting to get out there and take action. Quick tips. So I want to talk about a number of different things that I see, and I mean I could talk about tips for days, but these are the most important things that I see. So number one, and I have we have conversations daily about this. It is not about the value of your property. It is not about how much equity you have in a home. It is all about debt servicing. That's all the lenders are really caring about, to the minor exception of some net worth programs and some other special programs. For the most part, the lenders and the government are trying to make sure that you can service your debt. They do not want to overextend themselves, and even with a significant down payment, you still have to be able to qualify based on your income. So it's very important that you focus on debt servicing, which means that you should be focusing on cash flow property. Next, linking into that, take 30-year amortizations on all of your debt. And keep in mind, even on your residence, because yes, you of course want to pay off your residence in less than 30 years. Who doesn't? But if you take it on a 30-year amortization, you can make lump sums on that mortgage with most lenders. Most lenders allow you to pay off between 10 and 20% of the original principal balance per year with no penalties. And so it's a really important key to just focus on chipping away on that debt, but using the lump sum prepayment options as opposed to having a short amortization. We actually have this happen quite often. We're restructuring people's debt and re-amortizing them just in order to qualify for other debt. So something that's really important to keep in mind is that you should be taking 30-year amortizations on all of your debt. It gives you the lowest possible minimum payment. There's another one, eliminate all other high interest debt. And one of the things you're going to notice here is that a lot of this is kind of wrapping up into what we typically call step number one, which is getting a home equity line of credit on your residence. But eliminating all other high interest debt is a very important key. And let me paint a picture for you. If you have a car loan for 25 grand with a $550 a month payment, that payment is the same as borrowing 100 grand on a mortgage. 100 grand, because that is the stress tested mortgage payment on $100,000. And so it's a very, very important key to understand that sometimes to get started, we're going to look at doing a bit of a debt swap, which means that we'll be looking at, step number one, get a home equity line of credit, wrap up all of your other high interest debt and high payment debt. And sometimes the conversation is, well, Kyle, our car is a 0% interest loan. I know, but the payments are $800 per month, which means that if we eliminate that payment, we can increase your borrowing power by 150 grand. So a lot of time it's restructuring debt, lowering the minimum monthly payment in order to maximize your borrowing power. And that's why, again, getting a HELOC is usually step number one, and re-amortizing the debt, getting access to more capital, and paying off all of the other debt that has a higher payment attached to it. Follow the game plan. What I find sometimes some of our clients are, they go out and they buy one property and they go out and buy another property, and they're a little bit confused as to what their plan is, and they just kind of go after the shiny penny. What I'm going to tell you is that if you fail to plan, you plan to fail. Okay? If you fail to plan, you plan to fail. It's important to have a game plan. It doesn't mean that game plan can't change, but it means that you should have some clear direction on where you want to head with things. You should understand, okay, if this is where I want to take things, then this is the plan of action that I need to take in order to get to that stage. Last thing I want to mention on quick tips is surround yourself with experts who understand how to invest in real estate. What I find is that when we have clients that are new to our team and they've purchased one or two properties, perhaps they've gone to their own bank, or they've gone to somebody else who doesn't specialize in working with real estate investors. one thing I note is that they're often order takers, not order givers. And the way that I mention this is that if you go to somebody and you say, hey, I'd like to buy a rental property and I have cash for my down payment. And most people that don't specialize in working with investors, they don't understand the taxation sides of things, et cetera. A lot of them would say, oh, that's what you'd like to do. I will deliver what you would want. And they give you that approval with the mortgage, and they're going to allow you to use your cash for down payment. Now, if you came to us, our team would typically say, well, are you sure you want to use your cash for the down payment? Because if you took the cash, paid down your non-tax deductible mortgage, reborrowed that money back out on a home equity line of credit and use that to invest, then we could save you X amount per year in taxes. And this is exactly what we do on a daily basis, is helping guide people and saying, hey, did you realize that if you did it this way, you could save in tax? And that's a lot of what we do here is actually advising people on how they may be able to save money in tax by looking at simple maneuvers. And again, we always preface this by saying, talk to your accountant. But we are not order takers. We often will give direction and allow people to understand some of the things that they don't even know, and say, hey, maybe we should point you in that direction or this direction, or are you struggling to figure out where to buy or what to buy, or do you need somebody to help give you a third-party opinion on whether you should be buying that property or that market or this market? That's where we can help out, and it's not just us; it's lawyers, accountants, all these individuals. I have stories, and you'd expect, hey, they're a professional, they're an accountant. Well, it doesn't mean that they have any investor clients. Oh, this banker's been doing it for 15 years. Well, ask them how many properties they own. Ask them how many times they've worked with clients that have 5+ properties. You'd be surprised how many branch managers have only dealt with a client that has more than 5 properties once or twice in their entire career. So it is very particular. It is a niche market. Only about 4 or 5% of residential real estate is purchased for investment purposes. So guess what? Most people that work in the real estate sector will be focusing their efforts and energies on the 95 to 96% of buyers out there, and frankly, the easier to do deals. First-time home buyer, we have maybe 10 pieces of paper on file. A lot of our investor clients, we might have 100 pieces of paper on file. There's a very big difference, and it's a different area of expertise that's required for that. Now, last thing I'll mention here too is that for those of you who really want to take and treat this like a business, last year I actually started up a consulting company called Green Wealth, and what it does is it actually dives even deeper into helping clients build their real estate portfolio, especially those that are looking at aggressively building it. I don't have time to go into too much detail today, but really what it comes down to is removing the bias from the equation and effectively shopping, not just broker channel lenders, but lenders outside the broker channel. So giving you more lending options is one factor that the Green Wealth specializes in. And also just giving you a little bit more one-on-one coaching and training on, creating that game plan. We have a large onboarding package that we do, and really help people, specify and help create a more concrete game plan, and more access to myself to do that. So anybody that is interested in learning more about that, please reach out. But ultimately, at the end of the day, everything is unique and needs to be custom designed for you, right? We can't get up here and say, hey, look, this is the plan that every investor should follow, because it comes down to where you want to be in 5 or 10 years, which is one part of it, but also where you're starting from, right? And so we always say, look, we're happy to have a consultation with you, look at where you're at now, where you want to be, and then help you grow that portfolio and eventually, retire early is usually the plan, right? If you want to learn more, you can visit our website. We have upcoming webinars. I'm doing webinars on the first Wednesday of every month at 7 p.m. And so this is now a thing. I'm doing it every month. We have upcoming webinars, downloadable spreadsheets, FAQs, tons of information available on the website. So please check that out. Also, on top of that, anybody who's interested in learning more, I did co-author a book. I think it was 2 years ago when we did our book launch. It's called Rockstar Real Estate Investing. It became a Amazon best-selling book. Very easy to digest and read, especially for those of you that are brand new to real estate investing. It talks about a lot of fundamentals that I talked about today. But it's an easy read, and it gives you a quick idea of some of the basic concepts and fundamentals, and then also just a little bit about some of the more complicated methods and strategies of investing in real estate. So that concludes the presentation today. You can contact us by going to our website at greenmortgageteam.ca. You can email us at info@greenmortgageteam.ca, and you can call us at 604-229-5515. Thanks for coming out to the presentation. I'll answer some questions now. So I'm sure that I can see that there's lots of chat here. Let me go through this. Okay, awesome. So a couple of comments. So Dimitri was mentioning that you asked later about the readvanceable line of credit on a primary mortgage and the Smith maneuver. Yeah, so Dimitri, I think you're mentioning that you want to learn a little bit more about commercial and residential investing, et cetera. So some of these are previous webinars that I've already put on, and also upcoming webinars too. So we'll be there's a lot of information that you can learn about that. Let's see here. Okay, good. Thanks, Eric, for pointing Jane out to the Cashflow spreadsheet. That's awesome. There should be, Jane, there should be a downloadable spreadsheet on the website. If you're having trouble locating it, just send us an email at info@greenmortgageteam.ca, and we'll be happy to email it to you for sure. Peter has a question. So why pay off extremely low non-deductible debt when you can leverage for much higher yields? So I mean, I agree with that. I think that in most cases, what a lot of our clients are doing is they are taking leverage out. I've had more clients that have not had a mortgage in a long time take out $1 million mortgages and use that to invest in whatever they'd like to invest in, because if you can borrow money at sub 2% interest rates and invest it at 9-10% interest, it makes a lot of sense. That being said, some people still want to deleverage, and sometimes the plan is to take some of that positive cash flow or cash you have, pay down your non-tax deductible mortgage, which still increases your line of credit that you have available to you to invest, and then you reborrow that money and invest it out. So we do see that a lot of people are doing that. I'm going to actually stop sharing the screen here, and I can talk a little bit. Okay, so just going to open up my Zoom. Okay, there you go. Okay, a couple of other questions. Okay, so is the rent to price ratio the same as, is price to rent the same as rent to price? And usually price to rent. Okay, so the question is price to rent or rent to price ratio? Yeah, it's going to give you a different number. For whatever reason, I just like the rent divided by the price. That's just the way that I look at it, and I'm usually looking for about 0.4%. You can do it the opposite way, and then you have the metric in the opposite direction. It's just going to be a very, very high number, and effectively you're looking for, if you're dividing the price by the rent, then you're trying to get a low number on that instead of a high number. If you're dividing the rent by the price, then you're looking for the highest percentage number. But if you're dividing the price by the rent, then you're actually looking for something where it's a low price and a high rent. You're actually looking for a low number if you do it that way. So you can still do it that way too. It's the same two key numbers. You're just flipping it around. What's your opinion on investing in pre-sale versus resale? That's a really good question. So it's tough. Here's the challenge with investing in pre-sales. Is that you are investing now into tomorrow's market. And sometimes the market might be appreciating. But at the same time, too, the number of people that I see where their financial picture changes by the time that they go to close, and now all of a sudden, when they made that offer on that property, they wanted it. But by the time that the purchase date rolls around, all of a sudden, it doesn't really fit their game plan anymore. And so it's very important, if you are buying pre-sales, you should be planning for, okay, I'm buying these pre-sales. It needs to fit with my game plan here. Too many people buy pre-sales expecting that they're just going to sign it and flip the units before closing. It doesn't always happen that way. It doesn't always work that way. So it's really important that you consider, hey, what happens if I don't sell these units in that time frame, for sure. So that's an issue that I see come up quite often. Okay. I didn't even realize my camera was off this whole time. I should have put my camera on earlier. Okay, next question here is, how can I connect with your office thinking about buying multi-unit rentals? Jane, just you can email us at info@greenmortgageteam.ca. I have a residential team and a commercial team. So if you're looking at 5+ units, then that would go over to our commercial team, and myself and Amy handle all of our commercial business in our office. Devin has a question. So suppose you already have high leverage in a rental property, I assume getting a principal residence with a HELOC would require bringing other people on board or be very difficult if it's achievable at all. So it depends. So, just because you have a high leverage in your rental properties doesn't mean you will not qualify to purchase a residence. It really comes down to what the debt service ratio is. And so, that's a question, Devin, that frankly is very individual for each person. If you make $1 million a year, you can do a lot of stuff with that $1 million a year in income, right? So it really depends on your personal circumstances and how much you could qualify for. Let's see here. So I have a couple of people asking about more information or a link on Greenwealth. So I'll type it in here, but it's www.greenwealthcapital.ca. And there's more information that you can view on the website. And if you're interested in it, you can also book a time with me to go over that and actually discuss that in a little bit more depth. Effectively, it's a monthly subscription program where we just dive into our clients' needs and give them more of a individual like one-on-one support on that. So really diving into it, a lot more time and energy focused on that, and also really diving into helping create that game plan. At the end of the day, our mortgage company does get paid to do mortgage, and that's our focus. But I also found there's a bit of a need for giving that advice part of it too. And so we decided, hey, let's double down and let's offer more for our clients that really want that advice and are looking for that, and offer that as a service too. So anybody that wants to learn more about that, feel free to reach out. Okay, so next question here. Okay. And thanks, Maine. Yes, the Rockstar Real Estate Investing is a fast, informative, and entertaining read. Thanks. Kevin has a question. Does the location of the investment matter to the lender at all? So yes and no. Many major banks will lend across the country because they are generally more client focused. However, what you'll find is that you go from A lending to B lending to private lending. And as you move from A lending over to private lending, in general, what happens is the lenders are moving further and further away from the individual and more towards the property. And so private lending is based almost purely on, it doesn't really matter what the client situation is. What is the property? Where is it? How much are they putting down? And that's really what they want to look at. So private lending is very cheap, fast, or I shouldn't say cheap. It's very fast and easy money to qualify for. It's the exact opposite of cheap. It's actually quite expensive compared to A lending, at least. And B lenders kind of slot right in the middle. Sometimes they won't lend in smaller markets. A general rule of thumb is that 25 to 50,000 population or more is something that they'll look at. Now, A lenders still do look at property, but they'll look at the full picture. So they will look at the client. You'll find certain things like in smaller markets, they won't lend as much money on properties, especially expensive properties in small towns. Something called the sliding scale, where a lender will lend 80% of the first 1.5 million or so, and then a smaller percentage on the value over that. You'll find in smaller markets that might be 80% of 750 grand or 80% of $1 million, and then 50% of the remainder. So that is a factor. Also, during COVID, we did see that some lenders would cut down and say, okay, now that we're concerned about the marketplace, we don't want to lend in Alberta as much. And so we did have a couple lenders that cut back on their rental property exposure in certain provinces or certain areas. So yes, property is a factor, but it's probably not as much of a factor as you would think with major banks, because they're more client focused as opposed to property focused. Another question here: are you able to get a mortgage for a client without personal income but has money for down payment? So in general, a mortgage for somebody that does not have an income is very, very challenging. There are some net worth programs that might apply. And in general, the minimum cash you need for a net worth program is about $250,000 or more. But there are some net worth programs that could apply. In general, most lenders only have net worth programs available for owner occupied and not for rentals, but there are some lenders that do it for rentals too. But you do have to have a very high liquid net worth, and the net worth cannot typically be, mainly or mostly in real estate. Typically, they like to see that you have that in liquidity, and that's for two reasons. Number one, if something happened and you're all in real estate, then that's a bad thing. They like to see that if you could liquidate those funds to pay down the debt that you had obtained through the bank, then you can do that. And number two is from a profitability perspective. See, the banks also are looking at, can we cross-sell this individual and sell them other financial products as well? So being able to cross-sell you into managing your portfolio of stocks is something that the banks are definitely into. Let's see here. Are you running the Smith Maneuver webinar as well? So Kevin, we had a Smith Maneuver webinar a couple of months ago, and I believe that the previous webinars should be available on our website. But if not, just email our team, and we'll be able to send you that link so you can watch that. It was a really good webinar. Not to toot my own horn or anything, but it was really good if you wanted to dive into the nitty-gritty details about how it works and why you should be considering it. You should do that. On that note, two of my staff members are Smith Maneuver certified, which means they've gone through a course to learn all about this, and they're very well suited to be able to help set those types of facilities up, because they're a little bit more complicated and there's a bit more tax information and knowledge that's required for those. We have a question. So if you have many rental properties and cannot qualify, what options are there to borrow money at low rates if you cannot qualify? So this is a tough question, of course. If you have a lot of rental properties but can't qualify, then sometimes what people do is they'll have somebody else join up and co-sign for them. That is an option. If it kind of depends on why you don't qualify. Sometimes if you have a large portfolio and they're all residential properties, but you don't have a high personal income, sometimes the strategy is to actually get a commercial lender to come on board and offer a inter alia or blanket mortgage over all of the properties. And what happens is you're going to pay out all those mortgages, but the commercial lenders look at you more based off of the income of the assets they're lending on and less at you as the individual. So there may be some strategies there. Otherwise, private lending is an option, but I know you mentioned you want to borrow money at low rates, of course, but it is more challenging for sure if you can't qualify. But we do have to isolate why your qualifications might be tough. If it's credit, that's another completely different ballgame altogether. But in general, if you have a large portfolio and it's very difficult for you to qualify, if it's just the number of properties, then we definitely need to talk, because we have access to a number of more unique, obscure lenders that most brokers and whatnot don't access and don't use. Because if you don't do a lot of rental property financing, you wouldn't really have a need for more obscure lenders that finance 10 plus rental properties. But if the reason that you can't qualify is because of income, then you might have to look at commercial lending, which is something that we can help with too. Eldon has a question. So have you found deals where you put the deal in the property together and then joint venture with a contractor to build new construction or renovation? So absolutely. A lot of our clients have been doing that. I talked to a client earlier today in my consulting company who's looking at teaming up with a builder out in Manitoba, actually, to do something pretty cool. So I'm doing some due diligence on his behalf to kind of dig into that and figure out if I think it's a good deal or not. I also, on a personal note, just a couple of weeks ago, I actually purchased a 14-unit apartment building. A person in my mortgage franchise brought this to my attention. He said, "Hey, Kyle, can you help me with this mortgage? This guy has this 14-unit apartment building tied up under contract for $9.5 million, and the individual units are appraised for $12.5 million. And so he was looking initially for a mortgage on that property. So I said, yeah, I could probably get a mortgage for this guy on this property. But digging into it, I realized that he didn't have the cash needed to close on this. And so we dove into it. I had a conversation with the person that had it tied up and realized that he needed help with accessing the capital and putting the whole deal together. And what ended up happening is became a managing partner of the deal. So I connected to this person and brought in an investor to do to bring in the cash and the capital to do it. And now I've got my fiance running around on site, being the coordinator, making sure the painter is doing this and the landscaper is doing that. And the deal is quite lucrative, actually. The deal has about $1.7 million worth of profit, and the investor should make about 30% return on his money, closer to 50%. And when you annualize it, because we'll probably only need their money for about probably 7 or 8 months. So it's a really cool deal. And that's not the only situation. I run into this all the time where you want to ideally find people that have different skill sets and join together, like business partners and personal relationships. You're looking for people that can add value in a different way. And so if you've got cash and you don't know how to swing a hammer, then it's good to find people that have a different skill set to what you do. That's where we would help with building a pro forma and kind of helping with that. And sometimes we can actually help connect the dots on that. I'm working on one right now where a client of mine has a piece of property tied up, and we were helping him find a potential builder to go and do the deal with, somebody reputable that would help him be able to get financing on the property and actually build out a property. So next question is, Kevin, who are the best lenders for re-advanceable HELOCs? So most banks do have a pretty good product. The lender that we use quite a bit, Manulife has one of the best products out there. The only downside that I don't like is they don't have a line of a closed variable product available within it. So if you wanted a fixed rate mortgage and you wanted a cool product, then the Manulife one is cool because it actually can connect your bank account information into it. What that means is that instead of interest accruing on a straight line and then you make a payment and now the interest accrues in the straight line for the next month, instead interest accruing, and then your income comes in, and so your payroll comes in, and now it's on a slightly lower balance, and so interest accrues at a slightly slower rate during the rest of the month. And it's kind of hard to go into too much detail on, but the reality is that the Manulife one can result in a lower amount of interest paid depending on your situation. So that is a cool product. We use Scotiabank a lot. Scotiabank, the reason we use them is primarily because the product is very good, but also because we find that out of all of the banks, they're the one pushing the limits on how much money we can qualify our clients for. So they always seem to be a pretty good mix of a good interest rate, but also just being able to get a really high loan amount. The RBC Home Line is another good product out there too. So even though RBC doesn't work with mortgage brokers, I still like the RBC Home Line product. I think it's quite good. BMO's product and TD's product are pretty similar. They're both pretty good. They're both okay. Probably the weak one out there is CIBC. And the reason for that is that CIBC only allows for one mortgage and one line of credit component. I don't like that feature because a lot of the time what happens is you have a mortgage, which is a personal non-tax deductible debt, and then you have a line of credit. But as you invest, what you want to do is you actually want to take this money and lock that into its own mortgage term, because then you're not paying a line of credit rate on it, which is usually prime plus 0.5%. Instead, you'd like to lock that in and get prime minus 0.5% or whatever the going rates are at that point in time. So it's a lower rate by having it converted to a mortgage. CIBC only allows you to have one line of credit and one mortgage. And so I'm not a huge fan of that product, but most of the bank's products are pretty good. If the market doesn't appreciate but cash flows well, how would you refinance to pull money out to invest in more properties if you don't do a BRRRR? Okay, so if you're not BRRRing it, how would you refinance to pull out money to invest in more properties? I think there's a couple of things I should address here. So first of all, BRRRR is something when you're buying, renovating, renting it out, and then refinancing it. And so the strategy here is if you buy a property for 500 grand, put 50 grand into it, and now it's worth 600 grand, then you're getting a lift on the amount of money that you put into the deal. So the value goes up by 100 grand, even though you only put 50 grand into it. The strategy is that you do this, and then once you're done the renovations, then you refinance it, pull the equity back out, and go do it again. Now, so what a lot of our clients will sometimes look at is, well, I want to do a flip, but I want to make sure I have a plan B. And a lot of the time, this BRRRR, a lot of people in the industry call it, where you're going to just keep it as a rental property. It's kind of your plan B. And I always recommend on a flip, make sure you run the numbers and know what you're getting into if you have to keep it as a rental property, and see if it will be cash flow negative and by how much. Now, I think the question is, how do you refinance to pull the money out to invest in more properties? And the reality is you can only refinance up to 80% of the property value. So that's the number one. And then number two is many lenders will not allow you to refinance within the first year of ownership. So sometimes these BRRRRs are actually getting a little bit harder to do if you've only owned the property for 6 months. There's a product called Purchase Plus Improvements, which is good, where the lender will actually lend you at least the money you put into it. So if you bought it for 500 and you're putting 50 grand into it, they give you 80% of the total amount of 550. So they give you a total mortgage of 440 approved, but they're going to hold 50 grand of it set aside and wait until you've done the renos, and then they'll release the money to you. So at least you get, on a Purchase Plus Improvements, at least you get the money that you put into it cost-wise as a minimum guarantee. And then that way, if you can't refinance it for a year, maybe you can't refinance it to get access to that lift of that extra 50 grand, but at least you got your costs back out instead of getting stuck there. So sometimes we'll still set it up as a Purchase Plus Improvements. But yeah, if you're generating good cash, but the values aren't going up, William, the issue is you can only refinance up to 80% of the property value. So sometimes you just have to wait until the market pops. Another question here. Do you expect mortgage rates to go up soon? I was waiting for somebody to ask about mortgage rates. So there's variable rates and there's fixed rates. On the fixed rate side of things, it's controlled by two things: is the Bank of Canada and then the discount off of the prime rate. As of right now, the discount off of prime is very, very good. It's one of the best discounts that you'll see. Prime -1 is kind of standard for owner-occupied properties right now. You don't see that very frequently. In fact, most cases you're prime minus 0.6 or 0.7%. So variable rates are very, very competitive right now. On the flip side, fixed rates recently have gone up a little bit. Fixed rates were closer to 1.5 to 1.8% a little while ago, and they've since increased to 2.25 to 2.5, depending on what you're doing. Now, what I'm expecting for variable is that I think that the discount over time will probably not be as good as it is now. So I think that the discount will get a little bit worse. But if you already have a variable rate at a good discount, I don't think the Bank of Canada will be changing the prime rate for quite a while. The expectation is that the US Fed is probably not increasing until about 2024, which means I think we have at least 2 or 3 years of a flat interest rate environment for anybody that's in a variable rate. On the fixed rate side, slowly over time, we're going to see the Bank of Canada starting to ease off on their bond buyback program. Basically, what they're doing is they're not buying as many bonds, and over time, they'll start to ease off on that. Now, why that's important is that fixed rates are highly correlated with bond yields. And so if bond yields are down, then that means fixed rates are down, because generally banks go bonds plus a certain amount is the interest rate. So if the government is buying a lot of bonds, that means you have a lineup of people wanting to put money into bonds. And if you're issuing bonds to raise capital and you see that lineup, you don't have to offer the same high rate of return to raise the capital you need. You can lower your yields in order to still raise the amount of capital you need. So as soon as the lineup starts to dwindle, though, you might say, oh, geez, I have to start increasing the amount of interest I'm willing to offer in order to still raise the capital I need. So as the government starts to ease off and you have less buyers for bonds, you'll start to see that the interest rates will start to increase. Long story short, I think fixed rates over time will start to increase slowly. Right now, there is not any upward pressure. Bonds, after they spiked a little bit due to a huge $50 billion bond sell-off about 2 months ago, they flattened out again. And so I don't see any current increases to fixed rates. But over time, and maybe it's 3 months or 6 months or however long it is, bonds will fixed rates will slowly start to increase. But I don't think they're going to increase a whole lot. On the flip side, on the variable side, I don't see any changes with that. And I must say that probably about 90% of our clients are going variable, maybe 85%, but it's a pretty significant percentage because of the fact that it's a lower interest rate and it's a more flexible product as well. Okay. Let me just add a quick mention. So sorry, don't do BRRRR mean that if I get a property that I don't need renovation, so no active appreciation. I'm not sure what you mean by that exactly, William, but I may have answered the question earlier, so I think that might be fine. Cindy, if you change your primary residence to a HELOC, does that not affect what you might qualify for the new mortgage? Can you write off the HELOC when you're using it to pay off your residence mortgage? So, interesting question. Okay, so Cindy, overall, if you have a line of credit limit that's available, many lenders, not all, but many lenders will now assume that you're going to borrow the entire amount. And this is where we're talking about that game plan being really, really important, because some lenders, if you get a big fat line of credit on your residence, even if you're not using it, some lenders assume you're going to borrow the entire amount now. It makes it much more difficult for you to go and qualify for mortgages. But not every lender does that. And so sometimes we look at this and say, okay, in order to be able to do more and buy more, you'd have to get access to this line of credit regardless. And so sure, we're closing the door on a couple of lenders for you, but we still think that this is the best move for you. So kind of depends on the situation, but something to look at and consider. And when your question about can you write off the HELOC when you're using it to pay down your personal residence mortgage, the shorter answer is no. But there is a very complex maneuver within the book, the Smith Maneuver book, called cash damming. And there is a strategy that allows you to do that. And basically, in the simplest way I can put it, is what you do is you take your rent from the rental properties and use that to pay down your non-tax deductible debt. And then all of the mortgage payments and everything goes on the line of credit, and you just aggressively move it faster. I won't get into too much detail because it's quite complex, but the short answer is no. The long answer is there's kind of a way of looking at it. I have a question. Where is the apartment I bought? So it's in North Vancouver. It's pretty close to my office here in Vancouver. But it's a pretty cool deal. So it's been a lot of work. It's been a very active real estate market, and then adding that deal on top of it has been quite a go. But it's cool to be able to do that every once in a while. So. Another question, what can you do to reduce the capital gain on selling the investment properties? Good question. So there's a couple of different strategies there. The capital gains is difficult to get around. You want to talk to the accountants about this because there are a couple of different things that you can look at. Number one, if you own it in a company name, there may be more options available to you to be able to defer capital gains. Number two, is if you offer a vendor take-back mortgage to the buyer, so basically you're carrying a mortgage, you can actually defer your capital gains for up to 5 years by offering a vendor take-back mortgage on the property. So that is a strategy that you can also look at. Although a lot of people don't really want to carry back a mortgage, they'd rather just have their cash in their pocket. You may want to talk to an accountant about that because in some cases, there may be ways you can offset the capital gains if you reinvest money immediately during the same tax year. But that is a bit more complicated, and I'd have to defer that to an accountant to answer that question. So long story short, there's not a lot of ways of avoiding it, but there are a couple of little things that you can look into. All right, I think I had a couple of questions as well in the Q&A. So let's go here. Okay, so I have a question. So it's advisable to pay down payment of 5% for buying your home instead of say 20% and then use that for creating a line of credit. In other words, you would pay about 3% on the CMHC and then another 3% on line of credit, and still then it's worthwhile to pay 5% down instead of 20% down. Okay, so long story short, the down payment that you're looking at on your investment strategy, it kind of depends on the situation. So sometimes here's a strategy for a young professional who's making good money but doesn't have a lot of assets. If you buy a personal residence for yourself with 5% down, and then you turn that into a rental and then buy a new residence for yourself with 5% down, you've effectively purchased a rental property with only 5% down instead of 20% down, effectively increasing your return on investment. Because even though you're paying CMHC fees, even though you're getting a 25-year amortization maximum instead of 30 years, if you have a high enough income that you can offset what would probably be negative cash flow, because you're probably not cash flowing that property positive if you only put 5% down. If you can afford it, that's a way of building a more aggressive real estate portfolio. That being said, on the flip side, buying with 20% down and getting a home equity line of credit on your residence is also a very effective strategy too. It's a little less aggressive, but it is a more tax efficient way for you to build a portfolio. But there's moving parts, of course. If you put 5% down on a property that eventually became a rental, well, now you've got 95% of the value leveraged, which means you have a bigger tax deduction because you have a much bigger mortgage on the property than if you just bought it as a standalone rental. So there's some moving parts there. I would say in general, it kind of comes down to your strategy. If you have the 20+% down, I usually recommend just put 20% down on everything, save the CMHC fees, get 30-year amortizations on everything. But if you're just starting out, it's a great strategy to look at, okay, I want to buy my first home. What should I buy? Look and focus on something that might be a good investment property later. And look at, well, what if I turned it into a rental later? Then maybe you'll buy it for 5% down, live in it for a year or two, turn it into a rental, and then buy something else for yourself later on. Another question here, Mo. If you have many rental properties and cannot qualify, what options? I think we actually answered that one a little while ago. Jovan, for someone with enough in assets and stock portfolio, does it make sense to go down the special net worth programs, the 35% down from A lenders versus B lenders or private lenders? Good question. Generally, it makes sense to do it with A lenders with 35% down. But I will say this, there's an opportunity cost of taking that extra cash out of your investments to put down, right? So sometimes it actually makes more financial sense for you to leave your money in stocks and put 20 or 25% down with a B lender. What I would typically do is, again, I would take a look at what's the total return on investment, and I'd run again, this is the way I look at it, use the spreadsheet, right? What's the ROI in total by putting 20% down or 25% down with a higher interest rate with a B lender versus 35% down with the lender that would give you A lending rates but needing a larger down payment. And then I'd also have to factor in what's the difference in the down payment, and then what am I earning on my money on the other side, right? Because if you have to put 25% down with the B lender or 35% down with the A lender, sure, my cash flow is better with more down payment and a better interest rate and all of that. But also there's the opportunity cost. If I had that 10% in money that I can then invest and continue to invest in stocks or whatever, what's my return on that? So it's a combination. You have to look at all of those moving parts. It's math that I've done a number of times. It's not that difficult. You just have to kind of run the numbers and scenarios and figure out what the difference is. In many cases, it depends on what you're investing your money in. If you have your cash in low risk bonds, for instance, you probably just put 35% down because you're going to get a much better return on your investment in real estate. But if you're investing your money and you're getting 15, 20% per year investing your money, well, in many cases, and we've done this a lot of times, we've restructured clients' debt, giving them a bigger mortgage, but at a higher cost so they can have more access to capital to invest at a higher rate of return. And you look and weighing it off and say, well, it's going to cost you an extra $5,000 a year in your mortgage, but you're going to be able to make 20 grand a year by having an extra 200 grand that you can invest at 10% interest. Can someone get a loan using a mix of the net worth and part of the mortgage using a smaller income? So yes, many of the net worth programs actually look at like a topping up situation. So they'll say, okay, your income can qualify you for 400 grand, but you want an $800,000 mortgage. And so you have to have an extra 400 grand in liquid net worth in order to qualify for that $800,000 mortgage. So in many cases, they start off with how much your income can qualify for and then top you up with the net worth in addition to that. Okay, so next question. So is it advisable to pay 5%? Okay, yeah, we answered that one. When you get a second mortgage for a new personal residence, doesn't the first mortgage show up? Will they let you get the second one 5% down without changing the terms on the first? So actually, they don't care. So when you're getting qualified for a mortgage, it is your intention as of that moment that defines what kind of mortgage you get. So if your intention when you bought it was to move into it and call it a residence, then great. Now, if a year later you say, okay, I'm buying a new residence because of this reason, whatever reason it is, and now I'm converting the existing property into a rental, I could even take that back to the exact same bank that did the first mortgage and say, hey, this client's now buying another residence for themselves with 5% down. The existing one's going to turn into a rental, and this is how much income it's going to generate. And the lender will still be able to do that because your intention was that you were going to move into it, and you did. You have to be careful is sometimes if you have clients that buy property for $500,000, and then 2 years later, they say, oh, I'm going to buy a property for 300 grand further away from work, and I'm going to put 5% down, and I'm going to call that my residence. Well, the insurer, mortgage insurer, and the bank are probably going to look at that and say, well, are you actually going to move into it? It's further away from work. It's a smaller, cheaper property. Like, what's the story behind it? So you have to make sure that it makes a lot of sense that you would actually be moving into the new property, or else they won't do it with only 5% down. They're going to say, this is a rental, you need 20% down. And they're very sensitive to making sure that you're not, not looking at that. Jovan's talking about Dogecoin. Yeah, I've been joking about Dogecoin a lot too. So yes, of course. I want you guys, everybody here needs to borrow as much money as possible in your residence and your rental properties. Take out $1 million and invest it in Dogecoin, because that's where the money's at. So yes, but ultimately at the end of the day, it depends on where you can invest your money. There's a lot of reasons to invest, and there is good debt and there's bad debt, right? But I do say there is, leverage is something to use but don't abuse, right? If you abuse it and you over leverage yourself and you don't have liquidity over here, I've seen it where some of my investor clients get really hammered because they go way too heavy in real estate. They don't have any liquidity. They have a bit of a cash crunch for whatever reason, and next thing you know, they're selling off their properties at a loss because they didn't have enough longevity to just hold on to the properties for a long period of time. Georgina has another question. So if you have a rental property that they then live in as a primary residence, when you sell it later, do you have to pay capital gains? So here's how it works. Any appreciation that occurs on a property while it is the personal residence is not subject to capital gains. Any appreciation that occurs while it's a rental property is subject to capital gains. So if you live in a property, you bought it for 500 grand, and then eventually you move out of it and turn it into a rental, and now it's worth 600. You want to make sure you get an appraisal on it or something to validate what the value was when you decided to turn it into a rental later. Because any appreciation that occurred between you when you bought it and lived in it until when you moved out of it and turned it into a rental is not subject to capital gains. And it goes in the opposite direction too. So if you bought something as a rental and the value went up from 500 to 600, and then you decided to move into it and the value went up from 600 to 800,000, then the extra 200 grand would not be subject to capital gains, but the first 100 grand of appreciation would be. So it's important that you typically we advise get an appraisal. The assessments done by the cities are typically not very high, and so it's better to actually, especially if you're moving out of something that was a residence, get an appraisal. An appraisal is typically going to give you a higher value. All right, a couple of questions here. Let's see. So Kevin asked, how to change the investment to a personal residence and avoid the capital gains. So I kind of addressed that a little bit, where any appreciation that occurs while something is a rental property is subject to capital gains, and any appreciation that occurs on anything that is a residence is not subject to capital gains. You can't call everything your primary residence, right? So that's a question, something you need to look into as with your accountant. Interesting. I'll just kind of go on a bit of a tangent here, but you may have heard of builders where they'll build a property and they're always moving every year or two. You're like, how come this guy, how does his wife put up with this? He's moving every year or two, uprooting the family. Here's what happens. A builder is building a property, and generally speaking, to build a property, you usually want to put a 15, maybe 20% profit margin in the deal. Probably closer to 15% right now. It's pretty tough to get 20% profit margin. But you're building it. So if it's $1 million home, it probably costs land plus build cost, maybe 800, 850. But then the builder, the person that built it, will live in it for a year or two, and then they sell it. And the reason that they do that is because now that they've lived in the property, they can say, no, this is my residence, and they go sell it, and then there's no capital gains on it. So they're not paying tax on the money. That's an area that CRA definitely is heavily auditing and checking into, especially if you're always changing your personal residence. You always seem to be selling properties. So just be careful of that, but something to look into. Tony, if you have $1 million, are you all in real estate or Dogecoin or Tesla? I mean, for me, Tony, I understand real estate. That is my thing. If you look at the consistency of the real estate returns, if you can get 24 to 27% consistently every year by investing in real estate, then I'm much more comfortable with that. Keep in mind, though, it's a different investment strategy. Real estate is a long-term strategy because you have to wait until you see that appreciation hit, right? And sometimes stocks are the same way too. Sitting on Dogecoin, if you've been sitting on Dogecoin for a few years now, you haven't really seen a ton of appreciation until all of a sudden, right? So very, very different type of investment. Liquidity is one thing that's important to understand, and time frame too. But I think if you're investing in real estate for a long period of time, and you had $1 million, you could turn that into $5 million worth of real estate. And if the value of that $5 million went up by 10%, you've made $500,000 by parking $1 million into real estate. So in my opinion, I think real estate is a great asset class, but hey, guilty as charged. I'm definitely a very biased opinion here, because I've been helping investors build their real estate portfolios for years and years, and I've seen it. I've seen people that make 50, 70 grand a year become millionaires just by buying a couple of properties. It's super simple, super easy, and you don't need to have a lot of experience to do it. Honestly, that sometimes for some people, the easiest way to invest in real estate is just never sell anything. Just keep everything that you own. And if you just did a very simple strategy like that, you just bought your residence, kept it, buy a new residence, keep it, buy a new residence, keep it. And over time, by the time you're looking at retirement, you have 3 properties, they're all paid off, they're generating a few $1,000s a month in rental income. You've got your pension plan right there. And it's a really simple, easy way of building your real estate portfolio. It does not need to get complicated. And of course, I talked about some complicated things today, but it doesn't need to be difficult. It can be really easy too. And on that note, another great point is that real estate mortgage loans cannot be margin called like stocks can. Yeah. So as long as you keep making the mortgage payments, you're good. It's a very important point is that we're talking about the power of leverage. And yeah, I alluded to, yes, in theory, you can also get, high leverage in investing in stocks, but a bank's not going to call your mortgage if you're making your payments on time. Whereas in stocks, you can have a margin call, and that can be a really, really stressful situation for those of you that have ever been in that situation. So definitely, again, real estate is a very nice, safe, consistent asset class to be parking money in. And again, it doesn't mean you have to park all of your money in it. In fact, I believe that you should be diversified and you should have money set aside. And a general rule of thumb is 30 to 50 grand per property should be your minimum target as far as liquidity is concerned, because you might need it, and it's good to hold on to your properties for as long as possible. But yeah, you shouldn't be all parked in real estate. It's not a wise choice. Awesome. Any other questions? Answered all of your questions? So keep in mind the next couple of sessions are all going to be about investing in real estate. So I'll be diving into some of the topics that I talked about today, but a little bit more granular. So make sure you check it out. First Wednesday of every month, 7 p.m. I'll be doing this like clockwork. Thanks so much for coming out, guys. I really appreciate seeing all of you here. It's great to see a lot of familiar names and faces here. So thanks so much, guys. Have a great night, okay?